The Fed has to do what it has to do, but are the markets prepared for it? What have they already priced in?
Sure. So the market's fully pricing in that 25 basis point hike tomorrow, which we do expect. We have priced in almost 7 hikes or 170 basis points. So 25 basis points, so 6 more after tomorrow have been priced in, and then another 2 next year. I would say the market's pricing in very fairly in terms of the Fed hiking cycle. I think the question is going to be, is the Fed talking about going restrictive? Are they going to talk about going above 2.5? The market's pricing in about 2.3 endpoint of the hiking cycle. The question, I think, in the dot plot in the press conference is all going to be, are they talking about going above that 2.5%? I think that's not priced in. We're also going to be watching around quantitative tightening. When does that start? How quickly do they want to get the balance sheet lower? I think that's another big focus point. And really the threshold around inflation. I mean, we know a lot of this inflation is not something the Fed created or that the Fed can actually slow down. So I think the market's going to be watching, are they, do they want to get inflation down to 2% this year, next year? I think that tolerance for high inflation is going to be extremely important for risk assets, because I think the market might feel a lot more confident if the Fed is okay with a little bit of an overshoot, as long as it's heading in the right direction, because that reduces the chance of a policy mistake. So there's a lot. I think that first hike is not the market mover. It's going to be the dot plot, the communication about how far do they want to go and how quickly.
So Priya, let's talk about that quantitative tightening discussion that you just brought up here. Is the market fully prepared for that? And how important is that QT or quantitative tightening component going to be for markets as opposed to the rate hike cycle that we are kind of forecasting right now?
I'm glad you bring that up, because I think that's actually the one thing that's not priced in. I mean, I think the market's pricing in some probability of QT, but we have no details. We don't know what the caps will be. We don't know how quickly they want to ramp it up. Last time was a 12-month ramp up. Fed officials have been saying it'll be a faster ramp up to those terminal caps. But because we don't know a lot of the implementation details, I think the market has not fully priced it in. That's a key reason why I do have or our forecast for the 10-year is higher rates, because once they do start that, I actually think QT has much more implications, because the Fed actually now at this point, they're not just reducing accommodation, they will be tightening policy. They'll be lowering the balance sheet. Banks need a certain amount of reserves. It's a non-linear effect. Remember fourth quarter of 2018, at some point balance sheet is a lot more than hike. So I think, as the market starts to price it in, as we get more details, I think that's going to put some pressure, but not so much on the front end of the curve. It's going to be the 10-year. And remember, the economy is much more sensitive to the 10-year. So as the 10-year starts to move higher, we've seen a little bit of that move, leading up to today. But as that gets closer to 2.5, 275, I think that starts to impact the economy, financial conditions. So QT is, I think, actually going to be far more powerful for the Fed. And that's the one that markets are going to be really focused on.